Imagine you're walking down the aisle at the grocery store,
Okay.
and you're trying to be a bit healthier. So you pick up a box of granola bars, right?
Right, looking for the healthy stuff.
Exactly. And you flip it over to read the nutrition label. You see this one line that says, calories from protein, 50.
Mm.
And right beneath it, another line says calories from fat and sugar, 400.
Oh, wow. That's a lot of sugar.
Right. But here's the kicker. We look down to the very bottom, where that bold row usually is, the one that says total calories.
hmm
It's just completely missing. Like, it's blank.
So, the raw data is technically there, but the actual synthesis is just gone.
Exactly. I mean, the manufacturer might argue, hey, we gave you the ingredients, just do the math yourself.
Right, pull out your calculator in the middle of aisle 4.
Right. But we all know human behavior.
Yeah.
Most people are busy, they're skimming, they see the word protein, they see a low number, and they just throw the box in their cart, completely oblivious to the fact that they just bought a sugar bomb.
Yeah, they're totally missing the big picture.
And the structure of that label,
Yeah.
literally forcing the total to the bottom, that's what protects the consumer from their own tendency to skim.
That is honestly a phenomenal way to frame what we are tackling today because, well, when you transplant that exact behavioral psychology out of the grocery store and into the, high-stakes world of corporate finance,
It gets messy.
extremely messy. The consequences are a lot more severe than a sugar crash. We are talking about the potential misallocation of billions of Indian rupees.
And that is the perfect entry point for our discussion today. Welcome to a new deep dive on the JAP Advisors and Ind AS Clinic podcast.
Glad to be here.
Whether you're a CA student currently wrestling with a massive syllabus, trying to figure out why these standards actually matter in the real world.
Which is a struggle we know.
It really is. Or maybe you're an auditor gearing up for a high-stress review cycle. Or even a finance professional who just, needs to stay sharp in an environment that is constantly evolving. You are absolutely in the right place.
We have a case study today that completely dismantles the idea that accounting is just about making sure the debits equal the credits.
Right. It's so much more than that.
It really is about the architecture of transparency.
Before we pull back the curtain on this specific case, though, I do want to formally set our compass. Today's deep dive is entirely powered by the 232nd edition of the GAP Advisors Task Weekly newsletter.
Which is an incredible resource.
It really is. This newsletter is authored by C.A. Manish C. Iyer, who is the director of GAP Advisors, and is published directly on LinkedIn.
Right on LinkedIn.
Yeah. And we're going to be unpacking a lot of complex mechanics today. But if you want this kind of relentless forensic insight delivered to you regularly, you should really subscribe to the newsletter for free. I mean, 232 editions, that is a staggering track record of identifying these granular systemic issues.
It really is. And, as we prepare to jump into the actual financial statements involved here, we do need to establish the ground rules for our conversation today.
Always important.
Right. So the views expressed in this deep dive are the personal views of the author of the newsletter. They are not binding on you, the listener.
Of course.
We're exploring concepts and applications, but context and financial reporting is everything. You must always seek the help of a qualified expert before taking or, refraining from taking any professional action based on the views we're discussing here today.
Absolutely. So let's look at the context for today's puzzle. We are not dealing with theoretical models today, right?
No, not at all.
This isn't some textbook hypothetical designed to just test your memory. We are looking at a real-world observation drawn directly from the published Ind AS financial statements of an actual listed company.
And I think it's crucial to note exactly how this observation was made.
Right, this wasn't a regulatory probe, was it?
No, not at all. It wasn't a situation where the regulators forced the company to hand over secret files. These statements were downloaded and independently reviewed by GAP advisors on a suo motu basis.
So just on their own initiative.
Exactly. Meaning, GAP advisors simply looked at what this listed company proudly published for the entire world to see, and they proactively analyzed it for compliance.
It's essentially independent financial forensics. So here's our mission for this deep dive. Okay, let's unpack this. We are going to explore how a seemingly trivial formatting choice in a financial statement.
And it really does seem trivial at first glance.
Right, literally just how a company decided to label a few rows in their other equity section. We're going to see how that isn't just a stylistic quirk. It is a direct fundamental violation of Ind AS 1 and Schedule 3 of the Companies Act 2013.
When you call it a formatting choice, it almost sounds harmless, like choosing Arial over Times New Roman.
Right, like who cares?
Exactly. But in this context, the format is the language. If you mess with the format, you entirely change the story the numbers are telling.
Okay, so to understand how the rules were broken here, we first need to understand the regulatory architecture of this other equity section. Let's establish the parameters of the sandbox we're playing in.
Good idea. Let's set the stage.
For the financials we're dissecting, the reporting period follows the standard Indian financial year. So that's running from 1st April to 31st March.
Right.
And just to keep everything crystal clear as we go through the math, every single currency unit we talk about today is in Indian rupee.
Okay. So let's start with the blueprint itself. We're talking about Division 2 of Schedule 3rd to the Companies Act 2013.
Right.
For anyone out there preparing or auditing Indy financial statements, this is basically the holy grail of presentation. It dictates the exact face of the financial statements, including this specific statement of changes in equity.
And it's not a suggestion, right?
No, it is entirely prescriptive. It does not say, hey, please provide a general summary of equity. It gives you the exact grid you must use.
And looking at this grid right now, I mean, it is intimidating. It's not just a simple column for, money we have. Regulators have sliced the concept of equity into incredibly specific buckets.
They absolutely have, and there is a really profound logic to it. So instead of just reading out a mechanical list of columns, which would put everyone to sleep,
Please, let's avoid that.
let's group them conceptually so we understand why this grid is so complex.
Okay, I like that. Break it down for us.
So the first major conceptual bucket on that horizontal axis is essentially shareholder money and historical capital.
Okay.
This includes columns like share application money pending allotment, the equity component of compound financial instruments.
That's a mouthful.
It is, yeah. And then you have capital reserve and the securities premium.
Okay, so that first bucket, if I'm understanding this, is basically the structural foundation. It's the money that was directly injected by shareholders or structurally created by the nature of the financing itself.
Precisely. It's the bedrock. Then you move into the second bucket, which I like to call the operational engine of the company.
And that would be the retained earnings column.
Exactly, the retained earnings column. This is the cumulative, realized profit that the company has generated from doing whatever it is they actually do.
Like selling software or manufacturing cars.
Right, whatever their core business is. It's that profit minus the dividends they've paid out. It is cash-backed, realized success or failure.
Okay, so we have the foundation and we have the operational engine. That makes perfect sense. But then the grid introduces a third category.
Yes.
And this is where I think a lot of people, even really seasoned professionals, sometimes get a little dizzy. The other comprehensive income buckets, the OCI columns.
Yes, the infamous OCI buckets. Division 2 requires specific, entirely separate columns for debt instruments through other comprehensive income,
Yes.
equity instruments through other comprehensive income, effective portion of cash flow hedges.
Oh.
Yeah, it goes on. Revaluation surpluses,
Oh, well.
exchange differences on translating foreign operations, and a few more.
Let's just pause right here and really demystify OCI,
Yeah.
because it feels like the entire crux of this deep dive relies on understanding this.
It absolutely does.
If retained earnings is the cash in the bank from our operational success, what exactly is sitting in these OCI columns? Like, why can't we just call it all profit and be done with it?
Well, because it hasn't actually been realized yet. Or, alternatively, it arises from external market forces rather than the core business operations.
Okay, so it's not cash in hand.
Right. Think of OCI as a waiting room for wealth. Or you can think of it as paper wealth. Let me give you a very tangible example to make this concrete.
Please do.
Suppose our company, as a long-term strategic move, buys a massive chunk of shares in a really promising tech startup. We hold those shares. We aren't trading them every day. It's a long-term hold.
Okay, got it. So they're an equity instrument sitting on our books.
Right. Now, over the financial year, the market just goes crazy, and the fair value of those startup shares doubles.
Which is great news.
Amazing news. Our company is technically richer. We have a massive gain. But, and this is the key, we haven't sold the shares. We don't have that extra cash in our bank account to go out and pay our employees or buy new machinery.
Right, because if you put that massive paper game into the standard profit and loss statement,
Right.
it would make the company look like it had an incredibly successful year selling its actual products.
Exactly, which would be totally misleading to an investor. Imagine an investor trying to figure out if your core business model actually works.
They'd look at that and think, wow, they're amazing at manufacturing cars, when really they just made a lucky bet on a tech stock.
Precisely. You didn't get better at your business. You just rode a market wave on an investment. So the accounting standards step in and say, look, we need to acknowledge this gain because your overall net worth did increase, but we absolutely cannot pollute the operational profit with it.
So that gain gets isolated. It goes into other comprehensive income. It sits in that specific equity column away from the operational engine.
Yes. And the reverse is also true, right?
I was just going to ask about that. What if the startup tanks?
If that startup plummets in value, you take a massive hit to your overall net worth. But again, it shouldn't necessarily make your core factory operations look unprofitable to an investor.
Right, because the factory might be running perfectly and making money.
Exactly. So that paper loss sits in the OCI waiting room. So Division 2 of Schedule 3 gives us this massive horizontal axis of columns to ensure every single flavor of equity realized, unrealized, structural, operational is neatly categorized.
It's basically a highly organized filing cabinet for wealth.
That's a great way to put it.
But, the columns are only half the story. The grid also dictates the vertical axis, the rows.
Right, and this is where time enters the equation. The columns are what you have. The rows dictate the narrative of how those balances changed over the 12 months.
So it's the journey of the money.
Yes. Schedule 3 mandates that you start with a row for the balance at the beginning of the current reporting period.
Which obviously makes sense. You have to know where you started on, April 1st.
Right, you need a starting line. Then it provides rows to clean up any historical mess. You have to show changes in accounting policy or prior period errors, which then brings you to a fresh restated balance at the beginning of the current reporting period.
Okay, so we've set our starting point. We've purified it of any past mistakes. The foundation is locked in. What comes next?
This is the critical moment. After establishing that restated opening balance, the mandated format demands you show the performance for the year. And the very next required row, the row that is the absolute star of our discussion today, is explicitly labeled total comprehensive income for the current year.
Let me repeat that. Total comprehensive income for the current year. Not just profit, not just OCI. The total.
The total. You have to bring it all together. And this requirement doesn't just live in Schedule 3.
Right, because Schedule 3 is basically just the formatting blueprint, right?
Exactly. It's the visual representation of the actual accounting standard. If we look at the philosophical and, frankly, the legal backbone of this rule, we have to look at Ind AS 1.
Which governs the presentation of financial statements.
Yes. Specifically, we need to look at paragraph 106.
I actually have Ind AS 1 open right now. And looking at paragraph 106, it is incredibly blunt. It states that an entity shall present a statement of changes in equity, and it explicitly lists what that statement must include.
What's a point A?
Point A under paragraph 106 is literally total comprehensive income for the period, showing separately the total amounts attributable to owners of the parent and to non-controlling interests.
Notice that it is the very first requirement on the list.
Yeah, it's not hidden at all.
The standard setters did not bury this in a footnote somewhere. They made it the primary objective of the statement.
And it goes on from there. Point B requires showing the effects of retrospective restatement under Ind AS 8 for each component.
Right, dealing with the past.
And then point D is really the engine room of the whole thing. It requires a detailed reconciliation for each component of equity, showing the carrying amount at the beginning and the end of the period.
And what does it say about the specific changes?
It says you must separately disclose changes resulting from profit or loss, other comprehensive income, and transactions with owners.
That reconciliation requirement in point D is just fascinating. It's essentially the standard setters saying to management, look, you cannot just give us the April 1st number and the March 31st number and ask us to trust you.
Right. Trust us, we made money.
Exactly. They're saying you must show us the exact mathematical journey. We need to see the gears turning. We need to see how you got from A to B.
Okay, I am going to step into the shoes of our listener here for a second.
Go for it.
Maybe someone who's been auditing spreadsheets for 14 hours straight. Their eyes are bleeding, and they are listening to us obsess over this one specific row label. I can totally hear them asking, why does the label matter if the math works out?
It's the classic pushback.
Right. Like, if my retained earnings column correctly shows my profit, And my OCI column correctly shows my paper losses, and the bottom right corner of the grid correctly shows my total closing equity. Who cares if I have a single row called total comprehensive income? It's like giving someone the ingredients to a recipe. Do we really need to show them the picture of the final cake? I gave you the protein calories, I gave you the sugar calories. Add them up yourself.
Oh, that is the most common frustration in the field. Why are the standard setters being so pedantic? Why can't a company just list their profits and losses however they want as long as the final math is correct?
Exactly. Why the rigidity?
What's fascinating here is that standardization isn't about being bureaucratic or pedantic.
Right.
The friction here isn't about paperwork. It is about the fundamental psychology of financial markets. The entire global financial system relies on one thing: comparability.
Comparability, meaning an investor needs to put Company A's report next to Company B's report and read them in the exact same language.
Precisely. Imagine you are a portfolio manager. You are scanning 50 different listed companies to decide where to deploy ₹1 billion of capital. You are using automated screening tools, or at the very least, you are skimming these reports heavily because of time constraints.
Right, you can't spend a week on each one.
Exactly. Now, if Company A follows the rules and gives you a clear total comprehensive income figure right there on the face of the statement, you immediately know their holistic wealth generation. It's a single digestible number.
Boom, you have the answer.
But if Company B breaks the structure and leaves it up to you to hunt down the operational profit over here and then find the OCI loss hidden 3 rows down over there and manually calculate the net effect, Company B has fundamentally altered the readability of their financial health.
It breaks the machine's ability to read the data, and it breaks the human's ability to quickly assess reality.
And let's take that a step further into the realm of corporate psychology. Standard setters know that corporate management teams are acutely aware of how investors skim reports.
Oh, they definitely know.
Management always wants to highlight the good news and obscure the bad news. It's human nature.
Right.
So if a company has a highly profitable year operationally, but their strategic investments totally collapsed, creating a massive OCI loss, what do you think management wants the investor's eye to anchor on?
They want the eye to anchor on the word profit. They want the investor to see a positive number, feel good about the core business, and completely ignore the paper losses sitting in that OCI waiting room.
Exactly. And that is exactly why Ind AS 1 paragraph 106 and Schedule 3 are so ironclad. They remove the management's ability to play those visual games.
So it's about taking away the discretion to be misleading.
By mandating a total comprehensive income row, the standard forces the company to mathematically combine the operational wins and the strategic losses into one single unavoidable number. It is a forced synthesis. It prevents a company from hiding a broken leg just because their arm is really strong.
Okay, that brings the theory into incredibly sharp focus. The rules are designed to protect the reader from visual manipulation and structural ambiguity. So, to really understand these rules, we have to look at what happens when they are broken.
Which is exactly what this case study is about.
Let's look at the actual financials of the listed company that Gap Advisors reviewed.
This is where the theory hits the pavement. Let's walk through what they actually reported to the public.
Okay, I have the extracted data from their published Other Equity section right here.
Great.
We are looking at a 2-year reporting window. This captures the financial years from April 1st, 2018 through to March 31st, 2020. Let's look at how they structured their columns first.
Remember that massive list of possible columns we discussed earlier?
Yeah, the intimidating one.
This company, correctly, only used the columns relevant to their specific operations, which is perfectly compliant. You don't present an empty column for money received against share warrants if you don't have any. It just clutters the page.
Right, so their customized horizontal axis looks like this. They have a column for capital reserve, they have a column for securities premium reserve, a column for retained earnings, that operational engine we talked about, a column for equity instruments through other comprehensive income, or waiting room for paper gains and losses. And finally, the total equity column, summing it all up.
Okay, so the columns are solid. They did that part right. Now let's look at the narrative they constructed using the rows.
We start with their opening position for the 2018 to 2019 financial year. The row is labeled as at April 1st, 2018. Let's look at their balances.
And remember, we're talking Indian rupees here.
Yes, entirely Indian rupee. I am going to round these numbers slightly just to make them digestible over audio, but the scale here is crucial to understand.
Scale is everything in this case.
Okay. Their capital reserve is sitting at roughly 60 million Indian rupee. Their securities premium reserve is a healthy 106 million Indian rupee.
Very solid foundation.
Their retained earnings are sitting at about 15 million Indian rupee. And then we hit the big one. Their equity instruments through other comprehensive income balance is a massive positive 779 million Indian rupee.
Wow, so going into this financial year, they had a huge reservoir of unrealized paper wealth sitting in OCI.
Yes, a massive holding of investments that had gained value. When you add all of those columns together, their total equity opening balance on April 1st, 2018 is roughly 960 million Indian rupee.
Nearly a billion rupees in equity. It paints a picture of a very sturdy, incredibly well-capitalized entity.
A nearly billion rupee foundation, right? But what happened during the next 12 months?
This is where the formatting choices become critical. Let's look at what they did next.
Directly underneath that opening balance row, they introduce a new row to explain the year's activity. The row is explicitly labeled Other Comprehensive Income, Net of Tax.
Okay.
And in that specific column for equity instruments through OCI, they report a staggering negative number, a loss of roughly 742 million Indian rupee.
That is just
Right.
742 million rupees wiped out.
Yes. That negative number flows straight across the grid to the total equity column, showing a 742 million rupee reduction in total wealth.
Now let's pause and think about what could cause an OCI wipeout of that magnitude.
It has to be something catastrophic.
Absolutely. To lose nearly 750 million rupees in equity instruments without it touching the profit and loss statement, they must have had a massive strategic stake in another entity, perhaps an unquoted company or a subsidiary whose fair valuation absolutely plummeted during that year.
Right. It's a catastrophic drop in their net worth.
Yeah.
But watch what the company does next on the statement.
I'm waiting.
Directly below that massive OCI loss row, they introduce another completely separate row. This one is labeled Profit for the Year.
So they separated it out.
Entirely. Under the retained earnings column, they report a positive number, roughly 21 million Indian rupee, which again flows across to the total equity column.
So they present the catastrophic paper loss in one row, and then the modest operational profit in a completely separate row right beneath it.
Correct. And then they draw a line, do the math, and present their closing balance row, labeled as at March 31st, 2019.
Let's see the damage.
Well, their capital reserve and securities premium didn't move. Their retained earnings went up by that 21 million profit.
Right.
But because of that massive 742 million rupee OCI hit, their total equity absolutely craters. They go from an opening balance of 960 million Indian rupee down to a closing balance of just 239 million Indian rupee.
They lost over 700 million rupees of total wealth in a single year. That is staggering. And let's look at how they presented the narrative for the subsequent year, the 2019 to 2020 reporting period. Did they change their approach?
Not at all. They carry that 239 million rupee closing balance forward as the new opening balance, as at April 1st, 2019, and they utilize the exact same structural presentation.
So they doubled down on the format.
Yeah. They drop in a row for other comprehensive income. And once again, they take a massive hit, a negative 381 million Indian rupee in that OCI column.
Another devastating blow to their strategic investments.
Directly below it, the isolated profit for the year row appears again, this time showing a positive operational profit of roughly 14 million Indian rupee.
So again, presenting a positive profit number right below a massive OCI loss.
Exactly. And then we hit the final closing balance as at March 31st, 2020. The OCI loss was so profound this year that it completely cannibalized their remaining equity. Their final total equity ends up at a negative 128 million Indian rupee.
From nearly a positive billion Indian rupee to a negative 128 million Indian rupee in just 24 months, the destruction of capital is immense.
It really is. But here's the thing. Mathematically, if you are an auditor sitting there with a 10-key calculator running down the columns, the math works perfectly.
Right. The arithmetic is flawless.
Yeah. 960 minus 742 plus 2 and 1 equals 239. The horizontal math works. The vertical math works.
But the architecture fails. The presentation entirely violates the core mandate of the standard. Look closely at the rows they utilized to explain their performance. They used other comprehensive income and profit for the year. What is the glaring omission?
They completely omitted the row labeled Total Comprehensive Income for the current year.
Precisely. They presented the two components of performance, the OCI, and the profit as entirely distinct, unlinked concepts. They never consolidated them into a single mandatory row on the face of that statement.
They handed the reader the calories from protein and the calories from sugar and just left the total calories blank.
Exactly. It is an undeniable violation of Ind AS 1, paragraph 106, and the specific format prescribed by Division 2 of Schedule 3.
Here's where it gets really interesting to me, though, from a behavioral perspective.
Go on.
When you look at the PDF of their actual report, it looks so incredibly professional. The columns are perfectly aligned, the fonts are crisp, the numbers are huge. It has the visual authority of absolute accuracy.
Oh, I know exactly what you mean.
Right. It is so easy for an auditor or an investor to get completely hypnotized by the arithmetic and entirely miss the structural flaw.
Hypnotized by the arithmetic. I think that perfectly describes the pathology of modern financial reading. The human brain loves when numbers balance. When the vertical column sums to the exact same number as the horizontal row, the brain releases a little hit of dopamine.
You feel like you solved the puzzle. Ah, it balances. It must be true.
Right. We get so caught up in verifying the valuation assumptions behind that 742 million rupee loss. Like, did they use the right discount rate? Did they calculate the tax implications correctly?
Right, and auditing the numbers themselves.
Yeah, that we forget to step back and ask a much more basic question. Are we even using the right grammar to tell this story?
And the people who prepare these statements are under immense pressure, too.
Unbelievable pressure.
They are rolling forward Excel templates from the previous year. If the template was structurally flawed last year and nobody caught it, that flaw becomes institutionalized. It just gets rolled forward year after year, hiding in plain sight behind the math.
Absolutely. It becomes the status quo. So, let's pivot to the implications. We've forensically isolated the error here. We've established that it violates both the accounting standard and the regulatory schedule.
Right.
So, what does this all mean? Why does this actually matter in the grand scheme of things? If I am a seasoned analyst, surely I can just look at those two separate rows and do the mental math myself, right?
I mean, you'd think so.
An incredibly sharp, highly caffeinated analyst might.
Yeah.
But if we connect this to the bigger picture, financial reporting standards aren't built on the assumption that every reader is a forensic accountant.
Right. They have to be accessible.
They are built to guarantee a baseline of unmanipulated truth for everybody. Think about the psychological anchoring we discussed earlier.
Yeah.
Look at the 2 years we just reviewed. In year 1, the company lost 742 million rupees in OCI, but they made 21 million in operational profit. In year 2, they lost 381 million in OCI, but made 14 million in profit.
Right.
By breaking the rule and refusing to present total comprehensive income, the management team creates a visual landscape where the word profit appears on the page every single year as a positive standalone number.
I see where you're going with this.
A casual reader or retail investor or even an overworked junior analyst who is scanning 100 reports a day sees the word profit, sees a positive 21 million Indian rupee, and inherently feels a sense of stability.
It creates a massive cognitive dissonance. The core business is making money, but the entity as a whole is bleeding to death.
Exactly. If they had followed the rules and presented total comprehensive income for the year as a single consolidated row, the number staring back at the reader for that first year wouldn't be a positive 21 million.
It would be a devastating negative 721 million.
And that negative 721 million tells the true story of the management's stewardship of shareholder wealth for that year. The standard forces transparency.
By omitting that line, whether it was an innocent clerical oversight or a subtle intentional obfuscation, the company diluted the impact of their massive capital destruction.
They absolutely did, and this highlights exactly why the suo motu reviews conducted by GAAP advisors are so critical to the ecosystem.
They aren't just looking for bad math, they're looking for bad architecture.
Precisely. They catch the structural flaws that regulators like the NFRA, the National Financial Reporting Authority in India, are increasingly cracking down on.
The regulatory environment has fundamentally shifted recently, hasn't it?
Massively. 10 years ago, maybe an auditor gets a slight slap on the wrist for a formatting error. Hey, fix that for next year.
Right.
Today, regulators view structural noncompliance as a failure of professional skepticism. If an auditor signs off on a financial statement that clearly violates the presentation mandates of Ind AS 1, the regulators will ask a very terrifying question.
Was that?
They'll ask, if you missed the bold, explicit structural requirements on the very face of the other equity statement, what else did you miss deep in the footnotes?
Oh, wow. Yeah, that opens up everything to question. The reputational and legal risk to the audit firm is immense.
It's existential, frankly.
Which brings us to the most practical, actionable takeaway for our listeners today.
Yeah.
Because we don't just want to point out the problems, we want to offer solutions.
Right.
How do you protect yourself? How do you ensure you aren't the auditor or the CFO whose name is permanently attached to a fundamentally non-compliant document?
The solution is proactive defense. You cannot rely on hope. You cannot assume that just because the spreadsheet balanced, the presentation is compliant.
Exactly. We have a very specific directive from here. Do not let this happen to your financial statements. Get your financial statements reviewed by GAAP advisors before you sign them.
Before the board approves them. Before they are published and become a permanent public record of your oversight.
You can submit your financial statements in a near-to-publishing PDF format via email directly to info@gapadvisors.com. I will repeat that because it is crucial. info@gapadvisors.com. Having an entirely independent set of expert eyes specifically trained to bypass the hypnosis of the math and analyze the structural integrity, that is the cheapest insurance policy you will ever buy against regulatory action.
It truly is, but GAAP Advisors offers another resource that I believe is even more transformative for the day-to-day life of an auditor or a finance professional.
Other repository, yes.
Because the reality is you are going to encounter hundreds of micro-dilemmas during an audit cycle that are just as nuanced as the one we discussed today. You cannot hold the entirety of Ind AS in your working memory.
It's impossible.
Yeah.
The standards are massive, they constantly cross-reference each other, and they're constantly being interpreted through news circulars and real-world complexities.
Which is why the GAAP Advisors Issue Repository is such a monumental tool. It is the ultimate auditor's tool. For those who aren't familiar, this is an extensive knowledge base located at https://gapadvisors.com.
Let's really dig into what this repository actually is.
Yeah.
Because calling it a knowledge base almost undersells it. We are talking about an archive that currently hosts over 4,500 highly specific issues and their detailed authoritative responses on Ind AS and Indian GAAP, over 4,500.
Think about what that number actually represents in the real world. That isn't just academic theory. Those are 4,500 real-world moments of panic.
Right, actual problems people face.
Imagine an auditor sitting at a desk at 11 p.m. on a Friday, staring at a convoluted compound financial instrument with embedded derivatives, thinking, how on earth does Ind AS 32 interact with Ind AS 109 in this highly specific scenario?
And instead of just guessing or, endlessly debating it with a manager who is probably equally unsure, they have access to an archive where that exact scenario has likely already been forensically analyzed and resolved.
Exactly. But the most powerful feature isn't just searching the archive, it's the active consultation mechanism.
Right.
Any person can register for free on the site. Once registered, you don't just search. You can actually submit your own highly specific, complex issues on Ind AS and Indian GAAP directly through the platform.
And how is the answer delivered? It's not just thrown onto a public message board for people to argue over, right?
No, not at all. It is a highly professional, confidential process. You submit your specific issue, and a comprehensive, detailed response is delivered directly to the inbox of the email address you registered with at https://gaadvisors.com. It is literally like having a direct line to an Ind AS think tank.
Let's connect this to the day-to-day reality of an auditor, because finding the right answer is really only half the battle.
What's the other half?
The other half, and arguably the more terrifying half when regulators are involved, is proving that you did your due diligence. Documentation is everything.
That is exactly why this platform is a complete game changer. When the peer review board or the regulators come knocking to inspect your audit files, they aren't just looking at the final numbers you signed off on.
Right.
They want to see the narrative of your professional judgment. They want to know how you addressed the complex Ind AS application issues you encountered during the audit.
And if your only documentation is a sticky note that says, discussed with partners seems fine, you are going to have a very bad day with the regulators.
Exactly. But if your audit file contains a detailed, expert-backed response generated from the GAAP Advisors platform, delivered straight to your inbox, detailing exactly why a certain presentation format or valuation model complies with the standard, you have built an impenetrable fortress of documentation.
It's absolute proof of due diligence.
You have proven that you identified the risk, sought authoritative external guidance, and applied it systematically. It takes all the subjective guesswork out of the audit process.
It turns the murky waters of diagnostic accounting back into that clean binary X-ray we talked about at the very beginning. It gives you a clear line of sight.
It does. And the case study we've dissected today is the perfect proof of concept for why that clarity is so absolutely necessary.
We have spent the better part of an hour looking at the microscopic phrasing of a single omitted row in a grid.
Yeah, one missing line.
We've seen how standard setters built that grid to protect the market and how a seemingly simple formatting error obscured the destruction of hundreds of millions of Indian rupees in total wealth.
It really emphasizes that accounting isn't just math, it is communication. And when the grammar is broken, the message is completely lost.
Which leaves us with a rather profound and perhaps slightly unsettling thought to carry forward.
Yeah, this raises an important question. We've focused this entire deep dive on one specific listed company, a company that had massive scale.
Right.
They presumably had internal control teams, an internal audit function, a board of directors, an audit committee, and highly paid external statutory auditors.
Dozens of highly trained eyes looking at the exact same document.
Dozens of eyes. And yet, an entity of that scale completely overlooked a fundamental, explicitly mandated presentation requirement on the very face of their financials. They forgot to tell the market their total comprehensive income.
It's wild to think about.
If a mistake of that structural magnitude can slip through the cracks and be published for the world to see, it forces you to ask, what other subtle structural flaws are hiding in plain sight in the polished, beautifully formatted financial reports you read and rely on every single day?
Are we all just staring at the calories from protein, completely ignoring the fact that the total is missing?
That is the question.
That is a brilliant and necessary question for every professional to internalize. The numbers might balance, but is the architecture actually sound? You have to look closely at what isn't on the page.
Absolutely.
We want to sincerely thank you for joining us on this incredibly detailed journey today. If you found this analysis valuable, if it changed the way you look at a spreadsheet or a financial report, we have a favor to ask.
Please do share this.
Yes, please. Share this deep dive among your contacts. Send it to your colleagues, forward it to your audit and finance teams, and especially share it with the students pursuing their CA course. They are the future of this profession. The only way we improve the collective quality of financial reporting and restore absolute trust in the markets is to spread the knowledge of Indian accounting standards far and wide.
It's all about raising the bar together.
And finally, we want to warmly thank you, the audience, for your time and your dedication to the craft of financial accuracy. To ensure you never miss an analysis like this, we request you to follow or subscribe to the Gap Advisors Ind AS Clinic podcasts. We are available on Spotify, Amazon Music, and YouTube, whichever platform you prefer to use for your deep dives. We will be right back here next time, ready to dissect another complex case and clear up more of those murky waters. Until then, keep questioning the structure and never just assume the math tells the whole story.